the reason and rationale for teaching this course is very simple. My biggest pet peeve over the years, as I've sort of gone through the process of working with data, is that a lot of time people work with data, but when it comes to presenting their analysis or even doing their analysis, a lot of times they haven't really put in the work which is required to understand data. And I think a large part of today's class is to look at the starting point. So when it comes to understanding data, I think the biggest question is, where is the starting point? And in this specific case, I think what we're trying to do is trying to go through a data set that deals with Bitcoin prices, and we want to walk through that and see if there is some intelligence that we can derive from that specific analysis. So आज की exercise में I think main काम जो हमारा है, main focus is to look at the data set through multiple perspective and lenses, then to put together a simple model, and then to calibrate that model. There's one thing that I didn't get to do in the class, so I'll try and see if we have time today. I'll try and cover that also. So when it comes to perspectives, I think there are 5 primary lenses that we want to look at. And some of these lenses are common. Some of these lenses are lenses that you've used in the past, but there are other lenses that may be new to you. So the first lens is what we call absolute price, and this is a simple plot of data. The second lens is what we call percentage change, or also called relative change. So percentage change and relative change gives you a sense of how are things moving, and then later on when we're trying to model prices, you'll find that this is a really important piece of information. So if you think of this as just plotting prices, this gives you a sense of what lies underneath or beneath the prices. When you calculate this, when you have relative change or percentage change, it's also very easy for you to calculate volatility. And as I explained in the class, the same term, volatility, standard deviation, diffusion, these are all terms that are used interchangeably. Beyond these two, there is also this concept of correlation, but rather than looking at correlation as a single element, what we're really interested in is this concept of what I call trailing correlation. Correlations that we track just as we model a moving average. So we track correlations and also volatility as a moving average. And then we see, how far does that take us? And then the last piece is the distribution of relative change, distribution of volatility. Correlation की distribution नहीं बनती because it's only between -1 and +1. But we're really keen on seeing how the overall distribution of change and standard deviation moves. The models that we build are a function of what's the expectation and what is it that we're trying to do. So the most common models that we look at is trying to get a sense of what would past behavior, or how could we possibly use relationships that deal with past behavior and apply them to forecasting or predicting what future behavior would look like. So this is number one. This is the first application. A second application, or a second type of a model, is the classification model, where you've got data or behavior or categories and you want to sort of segregate them by either type or category or by behavior. So the common example of this is, if you've lent money to people, how many of them would actually pay back on time and how many of them would default. So default and current. If you have an insurance policy or an insurance product, how many of them would actually lodge a claim and how many of them would not have a claim. So these are segregation models. And then assessment is, is there a predictor of, let's say, identifying from a set of parameters which students would score an A? Is there a predictor of identifying from day one, which talent, which athlete has the potential to break, let's say, a world record? Then there are relationships. And with relationships, I think the biggest question we're trying to find out is there actual real correlation or is this accidental? And then if you have a multiple regression model, then if you have, let's say, 15, 20, 30 different variables that you're trying to factor into your model, which of those models are relevant and effective. And depending on what you want to do, the nature of your analysis and the type of work you do and the type of modeling you do would change. How do we use this in the model building process? We don't do enough, and it's not just a function of we don't do it enough as students, but a lot of times we don't do enough of this as professionals. A lot of times we have tools that we've gotten comfortable with using, right? So for if you work with stats, regression is something that we've always used and we're very comfortable with using. But when we look at regression and we work with regression, we've got a couple of parameters that we look at to see whether the model is a decent fit or not. And then when we see those parameters and we see those values, we say, okay, we're good. We're in good shape, so we can move on. So we want to challenge that. We want to say, each modeling exercise is going to depend on the nature and quality of data, and also on our intent. So depending on what our intent is, we might pick a different set of models. This is one. Second, there are certain basic rules, and I think one of the basic rules is I want you to do some level of data analysis before you figure out or finalize what the right model should be. Third, a lot of times, and you'll see this in the Bitcoin data set, a lot of times you see continuous behavior and then you see a step down, or you see continuous behavior and you see a step up. So there are step functions, and we need to figure out that there might be a different type or a different family of model applied to certain ranges, and then you need to model accordingly. Then I think we spoke about Talib. So we spoke about Talib's fooled by randomness, and Talib speaking about what he calls the generator function. And the objective of the generator function is you're trying to look at the data, you're trying to look at change, look at the distribution of change, mainly to get a sense of how our price is being generated. How is that underlying behavior being modeled? Is it something that can be captured by an equation, or is it something which is completely random? And even if it's completely random, what drives that randomness? A lot of times our modeling work will sort of stop here. And we say, we've got an equation that says x plus y plus z will give us a specific behavior. But what you want to think about is, why x plus y plus z? And is there a underlying theory that would sort of provide the rationale or intuition for the model that we're building? Is there something that we can use based on our understanding of the phenomena or the data set we're trying to dissect that can give us a better direction or sense of what the model looks like, and then take it from there? फिर एक और चीज़ होती है which is you might have heard of this, which are called splines. So मेरे पास इस तरह का model है, and this model doesn't fit really well to a typical traditional families that I'm used to and that I'm comfortable working with. So you might actually go out and say that, for this segment, I will use a different model, and for this I'll use a different model, and for this I'll use a different model, and for this I'll use a different model, this I'll use a different model, this I'll use a different model. So I've got 1, 2, 3, 4, 5, and 6. एक family और है, and that family, I don't know if you've read this or covered this so far, and that's called curve fitting. ये पढ़ा है आपने अब तक in your पढ़ाई so far? Have you done curve fitting? When we tweak our model parameters to get better fit. And then that brings me to the final point, which is, what is the definition of better model? How do we know what is the right model or a good model or a great model? And I think one thing that I see on a regular basis is that a lot of times we limit our sense of a good fit based on a couple of parameters that we've used on the modeling side. But there are better and there are more relevant and more real world assessment tests that, to my mind, I think the simplest test is you've got a forecast range that you've picked up. Okay, so how does that forecast compares with real world behavior? So rather than just looking at R square, or rather than just looking at the values for the p-test, and saying, gee, the parameters or the coefficients are significant. I actually want you to go out and say, here's a real price based on the model parameters that we think are relevant and interesting. And here's the model price based on the parameters that we've used. And here's the error and the difference between the two. So we'll cover a bit or an example of this a little later. What we want to do is we want to look at a data set which covers prices of Bitcoins from a certain point in time. And that data set is missing a crucial piece, which is more recent prices. So what we want to do is we want to look at our model. We want to look at basic simplistic regression models from Excel and then apply them and get a sense of can we get good fit using the model that we actually have. And let's see where that goes. So we start our analysis and our process by looking at the 5 lenses that we spoke about, and we want to see if those lenses give us a sense and indication of which direction we are going in. I use this is one of my favorite charts because I use this to show you how not to build a chart. In this chart, I've done you a big favor by putting this description over here that says BTC prices, but if I hadn't put that in, you would have no idea. What is wrong with this chart? One, I think you can clearly see that there is no date reference here. These are just numerical observation values. So I have a problem with that. And then if you look at the fidelity of this chart, right? I really don't know this is going up or down. And here also, I don't know which direction is up and which direction is down. So it's like sort of like a mess. So even though it's a scatter plot and it might have worked otherwise, but from an information, knowledge or intelligence point of view, this is a challenge. On the screen itself, you can see because you're watching this on your laptops or your display monitors. But in a classroom setting, if I put this up, you'd be hard pressed to see, at least I would be hard pressed to see whether the 70,000 was really 70,000. These are very small numbers on the side. So if you're thinking, and as part of your coursework in this class, if you go out and build models and you go out and plot them, please don't do charts and plots like these. There are a couple of basic things that your charts must have, and that's something it's a point I'm making. It's not really related to data analysis, but it's more along the lines of making your work both presentable, readable, and comprehensible. So the first lens, this was also price, and I'm now going to show you price, same data, same format, same layout, but a slightly different presentation. So to my mind, this is a slightly better display of information. So one, BTC prices, what does that mean? So this is essentially BTC expressed in US dollars, and it's a daily price series, and it's from 2017 to 2021. Now I can add more intelligence and more data here, which would give me a sense of when exactly in 2017 to when exactly in 2021, but I haven't done that intentionally because I want to highlight that. Second, the one thing that's missing here is source. Where did this information come from? And when you talk about daily prices, what is this daily price? Is it the opening price? Is it the closing price? Is it the adjusted closing price? And if it's the closing price, what is the definition of that closing price? So all of this data is missing. But again, from a presentation point of view, you can see that the font is bigger. You can see that dates are highlighted. So we can clearly see that in this specific instance, the first price is actually from 14 to 2020, and I'm sure this goes to 2021, which tells you that this 17 is not right. It should actually be 2014. And then it has also fit a trend, which is a non-linear equation, but this trend does not really do a good job. So it does a reasonable job here, which is one part of the data set, but it doesn't do a good job here, significant error, good job here, significant error, horrible job here, significant error, and really totally miserable job here, significant error. And I think then the next question that comes up is that this clearly looks like this is not a case for linear regression, but is there something that we can do using that model that can help us get to a structure that would maybe not give us perfect prices, but at least give us better fit than what we see here. So this is the first lens. Your second lens is relative change. So relative change, as I said, is percentage change. And there are many ways of calculating them. One is P1 minus P0 over P0. That's one possible variation. My favorite variation is ln P1 over P0 because that's easier to calculate and that's one less operation. You can use either of these. The numbers are, more or less equivalent or nearby as long as the change that you're calculating is relatively small. For larger changes, I think you'll find that the equations or the results will diverge from here and here. When I calculate results for the second lens, which is relative change, this is what I see. Now, once again, from a presentation point of view, you can see a certain font size, so that's visible, readable. It's BTC price, but this is BTC USD price plus a daily price percentage change, 2014 to 2021. Source is missing, so it's important to identify that. The orange line here is percentage change. The blue bars are BTC. You can also see that there are two indexes. You can put in the title of chart. You can also put in a short footnote, right? You can just put a short footnote here that says source in small font. That also works. You have a different lens that gives you a sense of, in this specific case, we can see that there is a trend line. We don't know what that trend line is. It's around 0. That's the average baseline. But there have been instances where on the low side, you've seen minus 20%. So this change, percentage change, you're reading from this axis. And BTC price, you're reading from this axis. This is the left-hand side, and this is the right-hand side. So percentage change is being read off the right-hand side. BTC price is being read off the left-hand side. 20% here, this is about, say, 15%, 15%, 18%, 17%, 12%, 15%, and this is almost about 35%. So something happened here, and I'm guessing this is essentially your May crash. So May 2020, when the COVID news was horrible. So May 2020 price crash. And we can dig into this and find out where exactly was this. And then you've had a period of relatively low volatility. This gives you a sense of how volatile or stable a space, a market, a product, or a price series has been. And you can sort of collate this right next to price movements. So this becomes a second lens. Then you've got a third lens. And your third lens is aggregate change. So aggregate change, what we've done is we've simply taken the data that we've seen before here, and we've summed it up. So now what I'm saying is I want to look at average, not volatility, but I want to look at average price volatility by year. And I want to compare that against where the average price for BTC or Bitcoin was in 2014, in 2015, in 2016, in 2017, in 18, 19, 20, and 21. And then for that given year, if I looked at the entire year, looked at the volatility throughout the year, what was the average volatility throughout the year for that given year? 14, it was 3.1% per year, 3% per year, 2% per year, 4.5% per year, 4%, 3, and then 4.6%. So 2021, from a volatility point of view, was the most volatile year, given the data set that we have in front of us. If we had numbers for 2022, we could repeat this analysis for 2022 also. The other way of looking at it is to actually calculate an index. So in this specific case, if I say 4.3%, what does this mean? This means that I've calculated a moving average of vol, and I've then averaged that moving average over the entire year. And that tells me that the average of some period. So let's say I've calculated volatility or standard deviation at, let's say, over a 10-day period or an 8-day period. And I've gotten this moving average series that gives me how vol has moved from one 10-day period to the next 10-day period. So I've got a stream of values, and then what I've done is I've just taken a quick average of that for every year. So that's one. Another way of looking at this is to look at not average volatility, but calculate some kind of a score that tells you which year was more volatile. So 14 was less volatile, 16 was less volatile, and then 15 was volatile. 17 was one of the most volatile years. And despite the fact that 2021 had a higher average volatility, from an aggregate percentage point of view, this was less. And then when you look at all these three trends together, that's what it looks like. So this is this green line that you see here. This is your trailing volatility. And what do I mean by trailing volatility? I've got a period that says this is Jan, this is Feb, this is March, this is April, this is May, this is June, and so on and so forth. And let's say I take the first 15 days and the next 15 days, the first 15, the next 15 days, first 15, next 15, first 15, next 15, first 15, next 15. So I've got a number here. This number is the volatility for that 10-15 day period. Volatility for the next 10-15, volatility for the first 10-15, next 10-15, and then so on and so forth. And this series that you see in green are these numbers. But rather than doing it 15 days and then the next 15 days, it's actually I just drop the last day and add the new day. So I've got a trailing series that gives me a sense of how vol has moved. And you can see, for example, here the time frame where you had the 35%, you can actually see that trailing volatility spiked. It was here a few days before, and then it came down again. But in this specific period, it just went up, shot up. Here also it went up. Here also it went up. And these are instances where it's running at about 10% on a daily basis. So the orange line is your daily movement, the green line is standard deviation, and the blue bars that you see are BTC prices. Even though this curve and this chart looks really intelligent and bright and sharp, and it looks you put in a lot of information and effort into it, I actually don't recommend it, because you're trying to present too much data, too much information in one bar, in one graph. This is something that you should only use as a last resort, or when it's asked for. If it's not asked for, if it's not needed, then avoid putting in too much information in one bar, in one chart. And the final lens is distributions. If I go back to your first chart, this is just a plot. This is a price plot. It gives you a sense of the direction and the trend line. Second lens is relative change. Gives you a sense of how volatile something is. The third chart is, okay, on an aggregate basis, on a year by year basis, which year has been more volatile, which year has been less volatile. On an index basis, if I look at not average volatility, but I look at how much movement was there in a given year, the index gives you a sense of, relative activity, or any given. It doesn't have to be volatility, it could be any other metric that you're trying to track for any other behavior. And then the third and final chart, which was all three of them combined, sort of gave you, it juxtaposed 4 themes that you'd looked at earlier and put them together in one chart. But the final chart, distribution chart, is a really important chart because it gives you a sense of what is the range of changes. So compared to the one that you saw earlier, which was just relative change, the distribution chart actually gives you a lot of intelligence. So between 2014 to 2021, your biggest one-day loss was this minus 37%. And your biggest one-day gain was a gain of over 22%. Your most common change was between here and here, here and here. And I'm guessing that's somewhere between 0 and 1%. That was your most common change. And the second most common change was a movement between, let's say, 2 to 3%. The third most common change was a movement between -1 to 0%. So that sort of gives you a sense of where the distribution is, where the bulk or the meat of the distribution is. You can also see that this is not normal. You can see that it's skewed. You can see that it has a fairly long tail on the downside and a little less, and it's because it's skewed in a certain direction, the chances that you'd lose are higher than the chances that you'd actually make money. But there's another way of answering that question. This plot by itself is not enough to look at it. We'll take a look at that also and get a sense if we can answer that question. That's one part. You can also take a look at the distribution of volatility. And the distribution of volatility gives you a sense of that, vol has been as high as about 14% plus. And on the low end, it's been close to 0. The most common change, the bulk of the distribution is, I would say, here, or if you want to extend it till here. So it's about between 0 to about 4%. That's where the bulk of the distribution is as far as trailing volatility is concerned. Now that you have all of this data together, I think the point that we want to highlight and identify is that this and this are not recommended. This because of style reason, for readability perspective. This because there's a reasonable chance that you're likely to confuse your audience or lose them. This is, I think, possibly the most intelligent form of processing that you've done, because you've taken this data, you've taken this data, you've taken this data to some extent, and you've compressed that into a form which you can actually use by putting it, by calculating it, by generating the distribution that you need to generate. Your primary objective with each chart is what's the point. So if I look at this one, what's the point? Point to get a sense of where's the trend. If I look at this one, what's the point? Number 2. So this is number 1. The point here is what's the trend. What's the point of showing you number 2? So minus 10 plus 10, that's the daily movement. Okay, that's a good one. Any chart, any plot that you present, you want to have a message that needs to go out with it. Can you see a relationship between volatility and price levels? So is there a linkage between what's happening here, niche, and what's happening here? Can you see that? Is that apparent? Is it not apparent? Is it visible? Is it not visible? Is there a linkage? And this is a really important question. Is there a linkage between these periods of high volatility, these periods of high price movement? Is there a linkage here? Or is there a linkage between these periods of high volatility and these specific dates? So ye volatility is linked to an external event, right? It's not a driver or a linkage between this, but an external event, and that external event was COVID. And this period of low volatility, is that linked to these increased changes in prices, this spike in price movement for Bitcoin? Or is that linked to some external movement which was linked to what was happening post-COVID? So there is some data which is there, visible in front of you, but there's some data which is contextually outside of the chart, which is with respect to what was happening in the world at that specific point in time, which is not captured in the information that you see in front of you. अच्छा जी, अब हमने ये किया कि हमने मॉडल बनाया और हमने कहा कि हम एक काम ये करते हैं. If I look at the trend, so if I go back to your price chart, where is your price chart? There's your price chart, right? So I say कि भाई ये एक चार्ट है, and then I say कि यार ये जो चार्ट है ना यहाँ तक का 17 तक का, right? इसके साथ मसला क्या है? This is where prices are less than 900. तो इसको काट दो. I'm not going to model this at all. So I'm going to start my model from 17th onward. So this is one model. ये एक मॉडल है, ये एक दूसरा मॉडल है, ये एक तीसरा मॉडल है, ये एक चौथा मॉडल है, ये एक पांचवा मॉडल है, right? So this is model 1, this is model 2, this is model 3, this is model 4, this is model 5. So I've got possibly 6 or 7 different variation models, because what I'm trying to do is linear fit कर रहा हूँ ना, तो linear तो यूँ fit होगा, या यूँ fit होगा, या यूँ fit होगा, या यूँ fit होगा, या यूँ fit होगा. So I want to make sure कि मेरे पास 5 separate segments के लिए 5 separate models हैं, and then I want to see how those specific models work. So पहला काम तो मैंने ये किया कि identify segments where I want to build the model, and I call them model A, model B, model C, model D, model E. My second thought was कि which one should we pick, and is simpler better? So one of the things we spoke about is simpler is better, but how do you assess and make that call whether simpler is better or whether your model is right or wrong? So हमने जो अपना सिस्टम बनाया या हमने एक्सरसाइज की, उसमें हमने कहा कि जी हमारी डेट्स ये हैं. सो ये स्टार्ट डेट थी पहली हमारी 17 से 18, फिर 18 से 18 का साल एंड, 19 से 20, एंड देन 20 से 21 के बाद मॉडल एंड्स. सो इसमें हमारी स्टार्टिंग प्राइस थी वाज about $1,000, and it went from $1,000 to $10,000. Here it went from $9,000 to $3,000. Then it went from $3,000 to $6,000. And then again from $4,000 to about $56,000. Right? ये हमारी price ranges आ गई. And the reason why we took these price ranges specifically was because these price ranges corresponded to 4 distinct time periods. They corresponded to 4 similar trends that we thought looked similar, and 3 potential possible family models. And in those, when I say 3 potential models, what does that mean? That means that in one model, your slope was positive, in one it was negative, and in one it is exponential. This is the exponential one, right? This is the exponential one. Can you see that? Can you see what I just said and what I've done? Then we said that we calculated correlations for these 4 periods. So the variables that we had the USD Euro exchange rate, we had gold, we had oil, we had unique addresses of Bitcoin, we had miners, people who mine Bitcoin, their revenues, that's miners revenue. We had the 3-month USD interest rate, we had the volume traded, not volatility, we had the USD JPY. So USD is a currency, Japanese yen is a currency. Here USD is a currency, Euro is a currency. And then we had the 10-day moving average for Bitcoin from the previous days. And then when we calculate these correlations, we could see that miners revenue is consistent. Even volume is consistent as far as sign is concerned. But if I look at USD Euro, it was minus 70, 78, 49, 57. If I look at gold, for example, 52, 59, 60. If I look at oil sign-wise is consistent. If I look at unique addresses, sign-wise is consistent. And then there's obviously this. This I don't want to use. This is sort of like something that I want to look at later. But I want to say, maybe the moving average has some intelligence that can be used to give a sense of better pricing and better predictive power. And we've got correlations, and we can see that while we'll go out and build a model that will work through all of these variables, we have 6 variables in total. But within these, possibly 3 are the ones which would possibly be better factors than the ones that we've used so far. And here's a fit. So for ye BTC, so this line, this is the actual line. This is model A, this is model B, model C, model E, model F. अच्छा, अब यहाँ पे हमने थोड़ी सी बदमाशी की है. एंड हमने बदमाशी क्या की है? हमने बदमाशी ये की है कि हमारा मॉडल का डेटा जो है, वो मॉडल डेटा कहाँ से? वो है 14 से 21 तक का, 2014 से 2021 तक का. लेकिन ये जो हम टेस्ट कर रहे हैं या एवेल्यूएट कर रहे हैं फिट के लिए, ये कब का है? ये 2023 का है. एंड मज़े की बात ये है कि 22 का डेटा था. तो 21 अबाउट, I think we have data that goes till about April 21. So we have nothing from the point of April 21 onwards. We have no data for 2022. And we want to see is whether the model that we build works, is relevant, fits, or fails. And you can now see, you can clearly see that it doesn't work, it fails. Fit is horrible. आपकी actual Bitcoin की price goes from, let's say, 16,000 to 20,000. Your predicted model prices are all less than 15,000. So on average, I'd say your fit is about maybe 30, 40, sometimes even 60, 70% off compared to the model. What do you think? ये जो हमारे पास model A, B, C, D, E, F है, what do you think are the R-square values and the p-test scores for the coefficients for these models, for A, B, C, D, E, and F? 60%. Okay, so we'll come back. So hold this thought. What was the R-square score for these models? And we'll come back to this a little later. When I switch to the Excel spreadsheet, I'll show you. I'm going to go back to some core lessons I want to remember. Simpler is better. Modeling में हमेशा हम कहते हैं जितने parameters कम हो उतना अच्छा है. So अगर आप और मॉडल और डेटा और पैरामीटर्स ऐड करें और इससे मॉडल की इंटेलिजेंस में इजाफा नहीं हो रहा तो मत इस्तेमाल करें. डोंट यूज दैट. Second, you have to respect data, which basically means respecting data means you need to spend time with it. You need to look into it. You need to play with it. You need to analyze it. You need to put it through the lenses that you have. If you just take the data set and apply it to a model, then you're not respecting data. Third, you have to remember what is the point. Not just the point of your analysis. What's the point of the model? What's the point of a plot that you're presenting? What's the point of a chart? Where's the insight? So a lot of times, and I want you to remember this because this is going to be really important for you. A lot of times when we present data, we actually just present data. Your customers, your clients, your partners, your audiences, your stakeholders are not looking for data. They can read it themselves. They're looking for analysis and insight. Where is the analysis and where is the insight? If you look at what we've done, we've looked at about 4 different lenses. What those lenses give, if they give us a different way of looking at the same data set, and in the hope in with the expectation that you might be able to build better models because you have a better understanding of the underlying data set. You also want to be very clear about the fact that don't do anything that would dilute the message or confuse your audience. You want to focus on readability. You want to identify your data sources, clearly identify and reference data sources. You want to qualify the usage and application of your models. You want to be very clear about the difference between correlation, accidental causation and attribution, and then frame of relevance. So यहाँ पे सबसे बड़ा मसला क्या है इसके अंदर? ये जो आपने डेटा सेट इस्तेमाल किया है ट्रेन करने के लिए, टेस्ट करने के लिए, ये डेटा सेट पुराना है. ये जो आप प्राइस फिट करने की कोशिश करें, ये प्राइस नहीं है. 1 साल का गैप है यहाँ पे. इस गैप की वजह से आपका मॉडल पॉसिबली ऑफ हो गया है. आप तो फिक्स कर सकते हैं, इसका बहुत आसान तरीका है. सो हमने क्या बात की? हमने बात ये की हमने मॉडल को 4 हिस्सों में ब्रेक किया. उसको ये हमारे 4 हिस्से थे. दिस वाज मॉडल ए. दिस लुक्स लाइक अ गुड फिट फॉर नॉन लिनियर multi-parameter model. This looks like a straight linear model. This looks like maybe a linear model, but there's going to be a lot of error here and here. This looks like an exponential model. So ये आपके 4 different segments आपने identify किए और आपने इसके 4 different models बना लिए. And that's one way of looking at it. But then what you want to do is you want to say in models का weight क्या है? Is there a weightage scheme that I can use that can allow me to sort of balance out the parameters, the intelligence, the relationships that are hidden between each of these segments and put them together?